Welcome to the Deep Dive.
Hello.
Today, we're digging into Clean Science and Technology Limited. We've got the earnings call transcript from January 30, 2025, and our mission is really to unpack their Q3FY25 results and see what the key takeaways are for their performance and their future plans.
Right. And they mentioned right off the bat, it's a tough environment globally for chemicals.
Yeah, difficult times, I think was the phrase. But they also stressed their robust margins and firm growth plans. So let's see if the numbers back that up for Q3.
Okay. Starting with standalone financials.
Yeah, let's do that. Revenue was, well, steady compared to the last quarter.
And the sales mix held steady, too. Roughly 40% domestic, 60% international. That seems pretty consistent for them.
But interestingly, on that flat revenue, the margins actually improved.
They did. They cited a favorable product mix and also lower utility costs helping out. So standalone EBITDA, it was up 8% sequentially, hit Rs 102 crores.
Which pushed the margin up to 45%. That's quite high.
It is. And standalone profit after tax, PD, also up 10% sequentially to Rs 74 crores. That's a 32.5% margin. Getting a 45% standalone EBITDA margin when the industry's supposedly struggling, that's significant.
It really suggests something about their process. Maybe their niche products are giving them some insulation.
Could be. It's definitely a key insight from the standalone numbers.
Okay, so that's the sequential improvement. What about looking back year on year? How did Q3 FY25 compare to Q3 FY24?
Year on year, the growth was quite strong, and they specifically said it was volume-led. Standalone sales jumped 20%.
Oh, okay.
Yeah, and EBITDA grew 18%, while profitability was up 19%. So solid growth compared to the previous year.
Right, now let's zoom out a bit to the consolidated picture. This includes their subsidiary, right?
Exactly. So consolidated sales for Q3 were 240 crores. Again, pretty steady quarter on quarter, like standalone, but up 23% year on year.
Okay, and EBITDA?
Consolidated EBITDA came in at Rs 98 crores. That's up 10% sequentially. And 14% year on year. The margin there was 41.5%.
Still strong, but a bit lower than standalone.
Right. And consolidated profitability, Rs 66 crores. That was up 11% sequentially, but only 5% higher year on year.
Ah, okay. So the year-on-year profit growth on the consolidated side didn't quite keep pace with the sales growth.
Correct. That likely reflects the impact of the newer subsidiary, which we can probably talk more about later. It carries higher overheads initially.
Got it. And they also approved an interim dividend.
Yes, Rs2 per share.
So the headline numbers do seem to support their claim of resilience, especially those standalone margins. But the consolidated view hints at the costs of expansion.
Precisely. It paints a picture of navigating challenges while investing for growth.
Okay, so let's talk about that growth. What's driving the business? What about the products and the segments?
Well, a huge focus is still on HALS, the hindered amine light stabilizers. They really ramped up volumes in Q3, averaged about 190 tons per month.
190, that's quite a step up.
Yeah, and the exit rate in December was even higher, around 200 tons per month. So the trajectory is clearly upwards.
And are they just selling more of the same HALS, or is the mix changing?
Definitely changing. They're diversifying. You've got the established grades like 701, 770, 622 still contributing. But importantly, they're now getting revenue from newer, more advanced grades. Things like 944, 119, and also 783, which is actually a blend.
These newer grades, 944, 119, are they higher value? Does that affect the average selling price?
That's exactly the plan. The average realization, or ASP, for HALS in Q3 was about $4.05 per kilo.
Okay.
But they're explicitly targeting $5 to $6 per kilogram for FY26. That's a significant jump.
How do they get there? Just price increases?
Not just that. It's really about the mix shifting towards these advanced HALS. Grade 944, for example, they mentioned could fetch $7 down $8 per kilo. And 119 might even be $8.99 per kilo.
Wow. Okay. So nearly double the current average for some grades.
Right. It's a strategic move into more premium HALS segments. That could be a major margin driver if they execute well.
And where do these higher value ones go? What are the applications?
So grade 119, that's mainly for agricultural films. Think Europe, Turkey, the Americas. Grade 944 is targeted more towards polyolefins, used in similar regions plus India.
And overall, how much did HALS contribute in Q3?
It was around 10% of consolidated revenue, so still growing, but becoming a meaningful chunk.
Okay, so HALS is scaling and getting more sophisticated. What else is new? Did they launch other products?
They did. Two key ones commercialized this quarter. First is DHDT.
DHDT, what's that?
It's a pharma intermediate. It's used to make lamivudine, an important drug. Clean Science sees this as a big import substitution opportunity.
Meaning replacing imports from China, presumably?
Largely, yes. They want to be a key domestic supplier.
Does this fit with who they already sell to?
That's a crucial point. Yes, it creates cross-selling opportunities because many potential DHTT customers already buy DCC, another pharma product they make.
Ah, so they already have the relationships. That should help speed things up.
Exactly. It leverages existing trust, potentially accelerating adoption. They spent about RS 30 crores CapEx on the plant for this.
Okay. And the potential revenue, ramp-up time.
They're projecting RS's 80-90 crores potential at full capacity.
Yeah.
Samples are out now, so it didn't contribute revenue in Q3, but they think they can reach optimum utilization in about 1.5 years. Faster than usual, partly because of those existing customer links.
Okay, DHDT. And the second new product.
That's BHT, butylated hydroxytoluene.
BHT, I've heard of that. It's an antioxidant, right?
Correct, for the performance segment. And again, there's synergy here. They sell it alongside their other antioxidants like BHA, TBHQ, ascorbyl palmitate. Same customer base.
Did this one need a big new plant too?
Actually, no. And this is interesting. They're making BHT using existing capacity within their HALS facility. So the CapEx was minimal, just erased 2-3 cores.
Really? That's very lean.
It is. Shows some flexibility in their manufacturing setup. They estimate potential for maybe 2,000, 3,000 tons a year, which could translate to, say, RS 60-80 cores in revenue.
That ability to repurpose or leverage existing assets seems key. Didn't they also mention stopping production of something, PBQ?
Yes. Parabenzoquinone, PBQ. They apparently struggled to meet the quality specs customers needed. So they decided to drop it.
But they're not letting that plant sit idle.
Nope. Again, showing that agility. They've already found a replacement product to make in the exact same facility, using the same equipment, again, with minimal extra CapEx.
Okay, what's replacing PBQ?
It's called barbituric acid.
Barbituric acid. Uses.
It's an intermediate for making pigment yellow, and it also goes into the FMCG segment. Like DHDT, it's currently mostly imported, mainly from China. They estimate the Indian market is around 100 tons a month.
And they have customers lined up.
They mentioned approval from a major one, Sudarshan Chemical, already, and they expect to start production within the next 3 months or so.
Pretty quick turnaround. Any idea on margins for this one?
On a pilot scale, they said gross margins look promising, around 50%. They're still mapping out the exact capacity they can get from that repurposed facility. It's a good example of them pivoting quickly when something doesn't pan out.
Definitely. So, looking across the segments in Q3, how did the revenue break down overall?
Performance chemicals remained the largest, about 69% of revenue. Pharma was around 18%, and agro-intermediates made up the remaining 13%.
And performance saw strong growth year on year.
Yes, they highlighted that, driven mainly by volumes.
What about capacity utilization across these segments? Did they have room to grow?
Seems like it. They reported utilization around 65% to 70% for performance. For pharma and agro combined, it was about 65%. And FMCG was running higher, around 80%. So yeah, there appears to be headroom in most areas with current assets.
Okay, let's shift gears from current operations to future building. What's happening with CapEx?
They've been spending, especially at the subsidiary, Clean Phenochem. Over the first 9 months of FY25, total CapEx was RS 160 crores, and most of that went into the subsidiary.
And they have more planned. I recall 2 big projects.
Correct. 2 significant ones, each budgeted around RS 150 crores.
Okay, what are they?
The first is for a completely new performance chemical product. They said construction is on track, and they expect commercialization in the second half of FY26.
Any sense of the potential from that one?
They estimate it could bring in RS 300 crores in revenue annually once it's fully ramped up, so quite substantial.
And the second, Rs 150 crore project.
That's for a water treatment plant. Construction is due to start literally any day now, first week of February 2025, aiming for commercialization by December 2025, which puts it in Q4 of FY26.
Likely for environmental compliance and supporting the overall expansion, I imagine?
Yes, almost certainly related to managing the increased scale of operations sustainably.
Now, you mentioned the subsidiary, Clean Phenochem, earlier affecting consolidated margins. It started up in March 2024, right? Can you elaborate on its impact?
Sure. This was a big greenfield project, a RS 376 crore gross block investment. When a large new plant like that comes online, it immediately adds significant fixed costs.
Like depreciation, salaries, maintenance.
Exactly. Those costs hit the books, whether you're running at 10% capacity or 90%. So initially, these higher fixed overheads drag down the consolidated margin compared to the established efficient standalone business.
It also messes with efficiency ratios, like revenue to net block.
It does. Historically, Clean Science was very efficient, maybe around a 2x ratio generating RS2 of revenue for every RS1 of net block.
But adding this huge subsidiary asset base.
Right. Their total net block is now around Rs 700 crores. Since the subsidiary's revenue is still in the early stages of ramping up, that ratio temporarily dips. It basically signals they have a lot of invested capital waiting to generate returns.
When do they expect that ratio to get back to historical levels?
They guided that it likely won't return to that efficient 2x level until sometime in FY27. Depends on how quickly the new products, especially HALS and that big new performance chemicals, scale up.
Makes sense. And the tax rate at the subsidiary?
It benefits from a lower rate, perpetually 17%.
Do we know how much revenue the subsidiary needs just to break even?
They give an estimate, yeah. Around Rs 11 to 12 crores per month.
Okay. And any factors expected to help the subsidiary's profitability soon?
Yes, they specifically mentioned expecting margin improvement at the subsidiary starting from Q4 FY25, mainly because acetone prices have corrected downwards. Acetone is a key raw material used there, so lower input costs should provide a direct boost.
Got it. Okay, let's talk market strategy now. Especially for HALS, given the volume ramp up, how are they getting it out there?
They're putting a lot of effort into building a global distribution network. A key strategy is appointing new distributors in places like Europe, Latin America, the US, the Gulf, South Africa.
New distributors, why not use existing ones who already handle chemicals?
Their thinking, based on the call, is that distributors already established in HALS likely have strong long-term ties to competitors, big Chinese producers, or European players like BASF, who they mentioned specifically.
So potential conflicts of interest or lack of focus.
Exactly. By appointing new distributors, perhaps those previously strong in related areas like phenolic antioxidants, but not tied to HALS competitors, they can get more dedicated partners. This is important because the HALS market has customers needing smaller volumes and local inventory, which distributors are good for.
How far along are they in setting up this network?
They estimated it's about 70% established now.
And what's the competitive scene like in HALS? You mentioned BASF.
They described it as very competitive, yeah. Both Chinese and European producers are active. BASF was noted as driving some pricing pressure.
So are prices holding up okay?
Not really, according to them. They stated quite clearly that current prices are at all-time lows across basically all their segments, HALS, performance, agro. Sounds like a pretty intense price war environment.
But they still feel okay.
Despite the low prices, they maintain they feel comfortably placed, likely pointing back to their cost structure or process advantages, allowing them to maintain margins better than some competitors.
Any potential upsides or specific market opportunities they flagged?
They did mention the U.S. market specifically. If tariffs were imposed on Chinese goods, that could create an opportunity for them, especially now that they're building out their U.S. distribution.
Makes sense to be positioned for that. And stepping back, what are their core strategic pillars? What guides these decisions?
They reiterated their focus on 1. Green chemistry and unique manufacturing processes. 2. Identifying and developing import substitution products. DHTT and barbituric acid are prime examples of this. And 3. A relentless focus on maintaining good margins, even if it means being selective. They did admit finding these kinds of niche opportunities isn't easy.
Any quick ESG updates?
Just briefly, yeah.
Yeah.
They added a 400-kilowatt rooftop solar plant at the subsidiary, boosting their renewable energy usage. And they've updated their sustainability report using GRI standards.
Okay, so pulling all these threads together, financials, products, CapEx, market, what's the overall outlook they presented?
The general outlook is for increasing revenue growth ahead. The main drivers are expected to be that continued HALS volume scale-up, plus the contribution from the new pharma intermediate, DHTT, as it ramps up. They specifically said they expect a much larger chunk of the HALS business to really show up in the numbers in FY26.
So this deep dive, based purely on that January earnings call, shows a company that's managing the current downturn pretty well, particularly on margins.
Right, especially standalone.
While making some pretty aggressive moves for the future, scaling HALS, launching these import substitution products, and committing significant CapEx.
Yeah, they're definitely not sitting still. They seem focused on building out these specific growth platforms, HALS, DHTT, barbituric acid, the new performance chemical.
Absolutely. So for you, the listener, maybe a final thought to chew on from all this. They have these ambitious targets for HALS volumes and getting that price realization up towards $6. They have timelines for DHGT, barbituric acid, and those big CapEx projects coming online over the next year or so.
A lot of moving parts.
Exactly. So how might the actual market reception to these products, the ongoing price pressures, especially in HALS, and just their ability to execute on all these plans, how might that interplay affect the revenue growth and the margins they actually deliver over the next, say, 12 to 18 months? Something to watch.
Indeed. Lots to track there.
Well, thank you for joining us for this deep dive into Clean Science's Q3 update.
Thank you.